Markets felt like they were all over the place in the second half of the trading week, and yet uptrends remain intact, and volatility is still relatively low. There's a bearish divergence I want to cover today, but it really just helps us out for a potential trade idea, not a full-on change in tone for the broad market itself. Welcome to the Trade Brigade Weekend Update. My name is Matt, and I want to show you not only the market pathing I'm watching for, but a new chart as well. It's directly related to that bearish divergence. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we've got ourselves a green-bodied inverted hammer-esque style bar. The reason I wouldn't just call it a straight-up inverted hammer is because the upper wick is not larger than the candle body, and therefore we did not close in the lower third of the week's range. So here are 2 great examples of pure inverted hammers, and this is an inverted hammer-esque style bar as we've dubbed it. So we don't want to ignore the selling pressure in the upper wick. There's definitely something going on there, but there was not enough selling pressure to even come close to testing the opening print, never mind get underneath the 50% mark of this week's range. So I would still argue from a structural perspective, buyers are in control. If we're thinking about location on the bar-to-bar count, we have a massive higher low as well as a higher high and a brand new all-time high close completely outside of and above the previous week's range. So buyers go 2 for 2 on the weekly count. The trend, of course, remains in the upward direction with lows, higher lows, and soft higher lows over here, because recall, in the 2-week balance range, the back-to-back inverted hammers, we never actually saw a daily downtrend emerge. It was more so just sideways activity, neutral on the trend. If we're thinking about the highs, we have highs, higher highs, of course, and this is a brand new higher high. And with the upper wick that was produced this week, it's very possible that a pullback could be around the corner, but if we're counting trend, if we're thinking about trend, analyzing trend, the uptrend is likely not going to change over the span of one individual week. It's very likely that if a pullback emerges, some sort of weekly higher low could be developed. Now, there are 2 locations where a higher low is technically reasonable, but one of them is far more advantageous. So let's talk about those now. If the market pulls back and can hold up over the top end of the 2-week balance range back here, that's an awesome place for a weekly higher low because it's a clear display of buyers being in control, turning previous resistance into newfound support. It's a weekly higher low, and we'll look for trend continuation after that. That's awesome. It also wouldn't be the worst thing in the world to come in for a full test of the soft higher low here and actually solidify that as a weekly higher low via some sort of daily downtrend that gets us there in the first place. So the 2 key levels that you want to focus on, the top end of the balance range here is at 549.50, and the bottom end of the balance range here is at 543.20, and we'll see all of these levels more clearly on the daily chart in just a moment. Are we getting any confluence with any of these things out of the Fibonacci's, anchored view apps? Let's check in. If we come from the low up to the most recent high, this is slowly creeping in the upward direction with this higher high that was obviously produced. It's no longer confluence with the breakout point over here. Not going to read into these too much. And we can come in from this pullback low up to the most recent all-time high. And you'll notice that the 38.2 is smack in the middle of the 2-week balance range. So my order of priorities whenever it comes to technical analysis is always price action levels first and then supporting evidence or additional add-ons like the Fibonacci. So although yes, this would be technically bullish consolidation over 38.2, the fact that it would have violated the top end of the 2-week balance range strikes me as being more important. So we'll leave that on the back burner for now. When these things are confluence with key levels, much more impressive. What do we have out of the anchored view app on the weekly? You'll notice that you are getting confluence here. This is a great example, right? Where in this particular instance, I would read into this anchored view app quite a bit. As long as we're over this area, I'm still thinking about the weekly higher low that we had just described. If we start to break down underneath, now all of a sudden I'm thinking about, all right, is it possible that a weekly downtrend starts to emerge? Is there some sort of weekly lower high that could then be set? Those questions are in force. But as of right now, considering where we closed on Friday, I would be sort of hard-pressed to imagine a strong weekly trend change in the next single week's worth of trade. So anyways, those are your key levels. That's the confluence I'm seeing so far, but it gets better as we add in the volume profile. Before we zoom in, because I'm just going to reduce it to about a year's worth of price action in just a moment, I want to remind you of an upper target, because technically, in an uptrend, we're still looking to exploit movements in the upward direction, so we should at least have some sort of target if there's just continuation. And the cup and handle extension here is still up around 570. 570 is a nice round number that I would use as a possible higher target, but now let's bring this on down to just a year's worth of price action. I want to walk through with you a couple of interesting indications. So first and foremost, there's a really nuanced high volume node right here, and it's the low of last week's bar. If we were to break down underneath that, what's the next high volume shelf? We do not want an arrow, we want just a straight edge. Here we go. That's going to be the top end of the 2-week balance range. The level, as we just described, is at 549.50. So if there's a break underneath last week's low, that's likely how you achieve a very mild pullback. It hardly looks like anything here on the weekly chart, right? Into the top of the 2-week range. But then beyond that, notice this high volume node here is the bottom end of the 2-week balance range. That level, once again, 543.20. And then underneath that is really where the deeper pullback starts to emerge. So as I'm really considering all of the data points here, the just strongest not strongest, but rather the most important over or under level on the weekly time frame really boils down to being 543.20, anchored VWAP support there, as well as high volume node support. If we start to drop it, it wouldn't be unreasonable for a deeper pullback into something closer towards that 525 level. So now that we understand that the higher time frame buyers are in control, we're all set with a couple of pullback levels, let's drop it down to the daily and start to get a bit more tactical and granular with our approach. The first order of business is always evaluating this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 566.51, implying a new higher high in the trend sequence, as well as a brand new all-time high. If we're contained by the lower bound, the number's at 553.49, implying a massive daily higher low. So loving what I'm seeing here. That's also a bullish indication out of the weekly expected move. The trend, of course, is up with lows, higher lows. These could turn into higher lows, right? If we were to just get consolidation up here, they'd be soft higher lows because there's likely not an hourly downtrend yet. No hourly downtrend based on Thursday's failure from the sellers. We'll talk about that on the hourly chart in just a moment, but this would more so just turn into bullish consolidation. I mean, from a pattern perspective, you've got yourself a bull flag, and any sort of break and higher low over the top of the 2-day balance range, maybe even 3, if we'll see this on the hourly in just a second, but higher lows on the daily over 561.75, and that weekly target from the cup and handle up around 570 are kind of what we're aiming at in the upward direction. Now, I'd totally understand if you're like, Matt, look at the Friday session. Like, that bar does not really look all that enticing. And you're somewhat right. Just like on the, or I should say, unlike the weekly chart, right? This actually is an inverted hammer where the upper wick is just as large, if not slightly larger than the body of the bar. But more importantly, you'll notice that we looked over the 2-day highs, 3-day highs at that point, and then closed back inside the midpoint of the range. So is this a look above and fail on what could be considered a balance range right here? It's certainly possible. So if you're looking for a short this week, I would firstly say underneath Thursday's low is sort of your gatekeeper. You've got to get underneath that for the shorts to start salivating at the mouth. And then if you're really looking for the aggressive breakdown, you want to be underneath the Monday and Tuesday 2-day balance range. Again, we'll see all of this with some more clarity on the hourly in just a moment, but what would the target be? We're talking about a move down here into that level we had just described in great detail at 549.50. When and if we were to get down here, I would certainly put my thinking cap on and say, where's the hourly double bottom? Where's the daily hammer candle down here? Where's the opportunity to set some sort of daily higher low or even weekly higher low at that point in time? If we bring out the not anchored VWAPs, but rather Fibonacci's, from the Monday of 2 weeks ago low to the most recent high. I just want to check in where the 38.2 is here. So anything that stays inside of the 3-day balance is actually bull flag consolidation from the perspective of this bull flag rally right here, off the lows up to the highs. I sort of like that, and the 38.2 is fairly close to the Monday low of last week. I'll carry that forward here. That 50 is sort of a key gatekeeper if the market's going to break down more aggressively. And notice also the 61.8 is sort of right there on the retest of that daily line in the sand at 549.50. So on the daily chart, our ups and downs are fairly straightforward. This gets you for continuation up towards 570. This starts to get the bears salivating, and your short probably looks something like this, with a reminder that down here, we're looking for a daily higher low. There's your DHL shipment, good to go. Let's drop it on down to, before we go to the hourly actually, let's go to an alternate set here. We talked about this on Thursday for the impromptu midweek market update. But we're banging our heads directly into the top end of a trend channel. So is it possible, let me frame it this way. would I be overly surprised if the market pulled back here and offered a move to the top end of the balance range? Absolutely not. Like, this is well within the bounds of healthy market activity from my perspective here in the overall trend channel. I mean, from top to bottom, seeing if we can find support near a structural area, which at some point, depending on how much time passes, might be the midpoint of the channel or even the bottom end of the trend channel, which would be bullish, right? Looking for support there. Anyways, let's bring it on down to the hourly time frame now. Get a little bit more granular. So, a couple of things I want to point out. The hourly trend, of course, is up. You've got lows, big time higher lows in here. It's very possible that you could get a higher low. It looks random in the midpoint of sort of this really volatile back, forth, up, down. It's all over the place, but this actually is an intraday anchored VWAP acting as support. So if you anchor a VWAP to the Thursday open, this is exactly where the buyers started to step up into that Friday afternoon with the market on closed sell. You'll also see, and this is sort of what I was pointing out on the daily, that this and this on Friday's intraday did act as resistance at 561.75, so I would prefer not to cherry pick the wick of the daily time frame chart at the exact high of Friday's session. So let's talk about upside pathing, then we'll talk about downside pathing. This is fairly straightforward, right? This is an hourly higher low, lows, higher lows, higher low at the anchored VWAP. Another some sort of, Brigade bolt over the 561.75. We're off to the races looking for blue sky territories. Anything that's really neutral and sideways, just chopping around in the balance, I'd fall back on daily bull flag consolidation. If we get underneath the 557.50 with a lower high, you could start to imagine how this triggers the beginning stages of a double top. Where's the neckline breakdown? Probably on a failure underneath this anchored VWAP confluence and the Monday low that we were just describing at 554.50. So that might look like, okay, here we're starting to set up shorts, and this is where we're actively, trying to trade from point A into the pullback zone, the top end of the daily range, the 2-week balance range at 549.50. At point B, we're changing our tone and saying, what's the exact opposite? Is it possible that we set up some sort of double bottom down here? Can we get some sort of inverted head and shoulders, a daily hammer candle? All of the reversal indications go for trend continuation and setting a higher low on the weekly and daily time frame chart at 549.50. Let's move along to, let's take a look at the internals. Now that we're pretty square on this, I don't think that there are any big revelations to make about the hourly sort of what should have happened, right? We could think about it like this. If stronger buyers were here, yeah, in theory, they should have gotten a close over the top of this breakout point here. So that's not really the case. We're in the midpoint of this range. But you could flip this directly on its head as well and say, well, if stronger sellers were here, why were they unable to get bear flag consolidation on Friday and then see follow through in the downward direction? And we all know the answer to that, or at least you should know the answer to that if you tuned into the Thursday impromptu midweek market update. This market internals dashboard really tells the story. If you're not familiar, check out the video tutorial in the top right-hand corner on how to set all of this up and what it all means. But we know that on Thursday, huge volume inflows. Advanced decline line was in trend higher zone all day. The cumulative tick really strong. So at the exchange level, there's a lot of participation in the upward direction, even though the market was selling off. So it's no wonder that even though we sort of closed weak on the lows, there wasn't a lot of strong selling across the exchange. It was all concentrated, right? We know that there's this concentration risk in the core list of companies. This concept we sort of dove deep in on the Thursday session. So let's evaluate now what happened on Friday with the follow-up to squeeze back up towards those highs and set a brand new all-time high. We definitely had strong-ish volume inflows. I'm not going to argue they're up and over 300 million, but they're definitely not neutral and flat like Monday and Tuesday. So I'll chalk that up to a win. The volume flows on the week were substantial, 742 million. 500 million is our over or under, net positive negative, right? So that checks the box. If we're thinking about the advanced decline line, it's up near trend higher zone all day on Friday. And what I want to make note of over here is that the index score was much stronger in terms of the bullish nature on Friday than it was the sell side nature on Thursday, right? You can clearly see how there are interactions at or above the green band up here, which is indicative of really strong buy side indications in all of the heavyweight components that really move the market in the first place. That's why this is bearish in the face of bullish internals on Thursday. This is what actually counts. And again, we did see a market moving lower. So higher level context versus more precise context out of the index score itself. In terms of the cumulative build, also positive on Friday, but not really a stellar read. I would actually sort of read into that a little bit, as well as the sort of failed breakout towards the high of day, and say at this point, it wouldn't be a shocker to me to get some sort of consolidation that then really builds a little bit more of an edge once we know whether or not we get the first indication of a short here or the first indication of a long here up and over that 561.75. And the bearish divergence divergence I was referencing in the intro of today's video, I'm going to jump around a little bit here, but we'll come back for a full analysis of the NASDAQ, is just the idea that the QQQ did not make a new higher high on that Friday session. So put that in your back pocket, which is also sort of supporting the idea that out of the S&P 500, this neutrality does not really strike me as being all that sort of crazy, considering that small push and pull from the NASDAQ versus the S&P. Let's jump on over to the market profile to finish up our supporting evidence. This is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. You can clearly see here, if we just get all of, let's go, here we go. We just want to make sure we can see Friday's range, of course. You can see that this is where there was the acceptance, or in theory, right? That's where a lot of volume actually transacted on the Thursday session. If the stronger sellers were truly there, again, we're putting ourselves in the shoes of the side of the trade that at this point has seemingly failed. Why in A period was it a straight shot higher? What that would tell me is anybody who shorted this late to the party on Thursday afternoon got squeezed out of the market, pinched out. And it's clearly an entire thin structure retracement because we did make a higher high here. And you'll also, more importantly, I would say, note that the value area is completely above this chunk of value from the Thursday session. So progress was made in the upward direction. You could also read into the idea that the low of day on Friday tagged up directly to the point of control from the Thursday session. There is one market deficiency here which supports the idea of a possible pullback. What might that be? It's the poor low from Thursday's session. Notice H, I, and J periods flat across the bottom. This is the improper end of the auction on the downside, and if this needs repair, it wouldn't be unreasonable that coming down from some sort of open in what's considered a 3-day range at this point to test the low of Thursday, that should break on the first test. And your level there is at 56.30. If that breaks, as we made note on the SPY cash ETF, right, we're looking at Monday's low. In the futures, that's 56.15. Anything below that really opens up the door into 55.80. That's the top of the multi-week balance range in your ES futures. So again, the larger break occurs underneath 56.15 to get into 55.80 on the futures charts, and that would be the equivalent of breaking down under this level to get into your 549.50 here on the SPY cash ETF. Changing gears to the QQQ NASDAQ 100 for its full interrogation beginning on the weekly time frame chart. What do we see here in terms of candle structure and location? Well, unlike the S&P 500, we most certainly have an inverted hammer on the weekly structure. Notice that the upper wick is certainly larger than the candle body, as well as larger than the lower wick. So if we tell ourselves the story, in the upper wick, sellers stepped up. They were able to push prices back down to the opening print. And because we've got ourselves a red-bodied bar, we know through the opening print for range expansion in the downward direction and a really weak close towards the lower third of the overall range. So the sellers emerge victorious when it comes to structure. But if we think about location, on the bar-to-bar count, we're still getting a meaningful higher low as well as a higher high. Unfortunately for the buyers, they were unable to close the week outside of or above the prior week's range. So no new all-time high close. You're still getting the higher high, higher low, so a little bit more neutral in terms of location. I would argue that if we fall back on the overall trend that's here, it's not unreasonable that the NASDAQ offers a little bit of a pullback. Now, I want to caveat that because clearly we've also seen prior examples of back-to-back inverted hammers, and they did not yield a pullback. So just because we have a bearish structure here does not mean, or guarantee, I should say, that a pullback needs to unfold, but I would probably say that the probabilities are higher that a pullback is more likely under these circumstances versus something like this or something like this. If we're evaluating the trend, we know that we have lows, and soft higher lows, just like the S&P 500, highs, higher highs, and a brand new all-time high was technically produced in last week's worth of trade. So we can certainly afford a higher low pullback, and just like the S&P, both of the levels are identical. The top end of the 2-week balance range and the bottom end of the 2-week balance range. The top end level is going to be at 486.75 and the bottom end level is going to be at 475.35. If this is all we get for a weekly higher low pullback, great, it's bullish, bulls on parade. If we get something that's a little bit deeper, not the end of the world, setting a more firm weekly higher low and trying to trade the trend back in the upward direction. More price acceptance underneath that level there at 475.35, and I would be more concerned about the possibility for a more drawn out pullback in the broad market market as a whole. We're not really getting any sort of Fibonacci confluence, just like we saw in the S&P 500. This is kind of in no man's land right now. And if we come in from here to here, 38.2 is smack in the midpoint of the 2-week balance range. Not going to read into that too much. If we bring out our anchored view apps on the QQQ weekly, this is confluence with the bottom end of the range, once again closer to that 475.35. I would read into that as a substantial indication. Let's go ahead and check in on the volume profile and see what's going on from this point of view. Let's auto zoom, and I'll also show you the sort of extension if the market does decide to move in the upward direction. We're not looking at the cup and handle, we're actually looking at this as a weekly bull flag that targets much closer to 520, right? If we did something like this from the cup and handle perspective, we hit that target, but remember, if you stack this one up here, it's actually confluence with the same exact thing at the 520, so you're all set if we need an upside target. But let's drop those off and let's bring this down to just a year's worth of price action like we did in the S&P, just to evaluate where these high volume spikes are. This one is the lower bound, and once again, if we sort of drop that area, I would be looking for a deeper retracement into this, and that's where we become concerned about a longer and more drawn out pullback in the marketplace. We're still definitely in a monthly uptrend at that point, so higher time frame traders don't really have a reason to panic unless there's a larger weekly lower high that's set and something more detrimental starts to emerge. Could this be the beginning? It could always be the beginning, but as of right now, I would not be doom and gloom about this market. Let's drop it on down to a daily time frame chart. Let's get more granular on the QQQ, and let's see what's going on here. So, as we already mentioned while we were in the S&P analysis, there's definitely a lower high on the Friday session, unlike the S&P, which set a higher high. It was still a look above and fail in the S&P, but this never made it there in the first place. Let's not get ahead of ourselves. Let's firstly evaluate this week's expected move. The upper bound is at 503.67, an equal high to what we had last week. Not really a bullish indication, kind of more so neutral than anything else. And this lower bound of the weekly expected move at 486.01 technically is still going to act as a potential higher low. So yes, it's a lower low underneath last week's range, but it's still direct confluence with the top end of the 2-week balance. That level we had just called for is at the 486.75 mark. So I like that down here. Doesn't need to make it though, because, or I should say, it doesn't need to contain price, I think is the more appropriate comment to make, because this sure was a CPI catalyst. And I don't think we're out of the woods from a catalyst perspective. Obviously, we're coming barreling into Q2 earnings, and if the technology cohort does not really report stellar earnings, it doesn't, I don't feel as though the volatility has accurately been priced in for this coming week's worth of trade. Maybe I'm getting a little bit too subjective here and not remaining objective, but that's sort of my feeling at least. So what do we see in terms of trend, in terms of analysis, candle structure, all the basics? We're definitely dealing with the opportunity for the uptrend to persist. We just talked about that, the key level 486.75. But in terms of structure, not only did we not make the new higher high unlike the S&P 500, but this is a bearish 3-bar play that's set up. On the daily bar, we've got an inside inverted hammer. So all it's going to take is a flush of these equal lows, and this pullback should be like no problemo for the market. Underneath 491.25, targeting that 486.75. But when we get here, I would definitely be open-minded to setting that higher low, both on the weekly chart as well as the daily chart. We are still pulling back from the highest high in the trend count, although we didn't make a higher high on Friday. Technically, the sort of origin of the pullback is the highest high. So I'm still thinking about daily higher lows, and as we'll see on the market internals in just a moment, there's actually some bullish divergence underneath the hood, even though we talked about the bearish divergence, S&P versus NASDAQ, with this lower high on Friday. One of the things you could also read into here is just that 500, the psychological number, was acting as resistance on Friday. So what's the pathing on the daily chart? As we just talked about, this is not unreasonable. When we get down into this zone, it's not just a blind buy down here, but if we could spot some kind of daily hammer candle, if we could spot an hourly double bottom, inverted head and shoulders, which hint might produce something like a hammer candle on the daily, then I would be willing to sort of try along there in terms of tight risk reward, right? You're just going to put your stop directly underneath that, trying to support over this key area of market structure, and the trades want to ultimately, over time, try to aim back at the highest high, the all-time high in the market. Now, again, you don't need to trade this as a swing trade. You don't need to enter swing longs here and make it all the way up to this high. But the general consensus location-wise from a trend-following perspective is that it's more advantageous to be thinking about longs here at possible support versus new money shorts, all right? If catalysts from earnings start to develop as being like, oh my goodness, things aren't going so well, then okay, any sort of lower high inside of the range here sets up the rotation to the bottom end, which was our next weekly level at 475.35. If the bulls are really going to be be on parade, I would prefer to see some sort of acceptance over this level here at 495.50, or, even better than that on the daily chart, some acceptance over 500. So on the daily chart, this is all just consolidation until proven otherwise, right? So acceptance over 500 really starts to suggest this, and as we talked about, your weekly target from the bull flag, 518, 520, from the bull flag and the cup and handle that we had just sort of explored, right? Let's come in here with the Fibonacci's on the daily from the bottom of the move up to the top of the move. Notice that we technically explored under the 38.2 on Thursday, closed above on Friday. So, again, as long as this is just sideways up in this area, it's bull flag consolidation until proven otherwise. Things become a little bit more dangerous when the 61.8 is dropped, as potentially, aligning beautifully with structure at the 486.75. Let's take that off and move on down to the hourly time frame chart here. And what do we see? So let's put ourselves in the shoes of each side of the trade. If you're a stronger seller into the close on Thursday, Friday is uncomfortable. Notice that intraday, there's this pullback that supports over the Monday and Tuesday lows, which is 495.50. So at first glance on Friday, or I should say midday on Friday, things are actually looking up for the buyers, trying to make this progress back up towards that high. It's this close back underneath the Monday and Tuesday low, the consolidation low from the mid-morning session as well, again, 495.50, that start to become detrimental. So how would I trade this going forward? It seems likely to me that the hourly trend could flip to down with highs, lower highs, if we trade into some sort of equal low here, and as described on the daily, the 3-bar play to the downside just means a breakdown of this 491.25 into 486.75. So, early on Monday, if we just get bearish consolidation here, the H pattern, the 3-bar play is still setting up, sweep the lows, and we're making this trade. When we get down here, thinking about double bottom, thinking about inverted head and shoulders, thinking about hourly hammers, as we had just described. It might be difficult to trade this back in the upward direction because you are going to have to trade back through this as a key level. So if you're a little bit skeptical of trading the 486.75, if you're like, I'm not a believer there because, the risk reward doesn't maybe seem right to you or something, like let's say that you're scared of this and then a rejection off of that, which is a reasonable threat. Like I'm not trying to minimize the degree of that threat, but how might someone want to trade this with more confirmation? Well, this has to turn into sort of a more severe inverted head and shoulders, and your Brigade bolt higher low over 491.25 sort of unlocks the, okay, we're clear of this low, things are improving a little bit, let's see if we can make it back up towards that equal high. What are we getting here from an intraday anchored VWAP perspective? Let's take a quick look. You've closed underneath the Thursday anchored VWAP on Friday's pullback, and this is also under threat. Notice that you closed below it on the Thursday session, and it's not really confluence with the key level. In the S&Ps, it's up here, but you've already violated that in the NASDAQ. So, any sort of rotation into these lows at 491.25, it would seem likely to me that being below 2 of the 3 key anchored VWAPs, this breakdown is not unreasonable. This one will meet us for confluence at 486.75. Here are the market internals, and this is where we've got to sort of step it back a little bit and say, okay, wow, on Friday, there's actually really substantial volume inflows. This is one of the strongest weeks in terms of volume inflows I've seen in a very, 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 very long time. 1.13, not million, billion shares traded, into up stocks through the duration of the week. That's a very, very strong read here at the exchange level. If you look at the advanced decline line on Thursday and Friday, it's giving you that bullish divergence, at least to the sell side activity on Thursday as well. And then your cumulative builds speak for themselves also. So, when I think back to the hourly time frame chart and to what scenarios make sense to me, obviously the concentration risk in the heavyweight components seem like the threat here is totally warranted. But when and if we get into 486.75, if these things, big air quotes here, need a breather from the sell side activity, I know it's only been a day and a half, but if they need a breather from that sell side activity, and we're finding support here potentially out of the QQQ and the broader market is also holding up, I'm not necessarily afraid to shy away from 486.75 pullback longs off the top end of the daily balance that we were just exploring. Let's go on over to the market profile for the NASDAQ side of things. A lot of the same indications as the S&P, a couple of bearish differences to point out. Notice that the market was unable to close the single print in B period versus the S&P, which obviously made a new higher high. You do have an excess high on Friday, a great excess low on Friday also. You are supporting and a bulk of the value area, all of the value area is over the point of control from Thursday, but you do still have this poor low indication as well from the Thursday session, reinforcing the idea, if we just bring it full circle, that underneath Thursday's low, a little bit of that harsher pullback can unfold to close some of this thin structure and tag up to something more meaningful on the daily We'll say it one more time, 486.75. And finally, the IWM Russell 2000 small caps on the weekly time frame chart. One of these things is not like the other. How many weeks in a row are we going to be able to say that? You've got a huge green-bodied bar out of the Russell weekly, very minimal upper and lower wicks in relationship to the size of that bar. We know that a lot of the bar is comprised of the huge gap up on the Thursday morning from CPI. We'll get to that in just a moment, but the weekly structure has to strike me as bullish. The location has to strike me as bullish. This is completely engulfing a majority of the bars from the upper portion of this consolidation, and of course, it's closed above as well. So from the weekly perspective, you could consider this a bull flag breakout. You could call this the avoidance of a head and shoulders pattern. This neckline is totally off the table. You've made a higher high in the overall trend count, and we are technically coming from a major higher low as well. I want to look left on the weekly time frame chart with you guys and look back a little bit further just so we can see what we're up against here, because when the market tried to break here in the first attempt, remember that the bottom end of the overhead supply is really what caused that rejection. We closed this weekly bar technically inside of that overhead supply and above this rejection point from back here as well. So that does strike me as a positive step in the right direction. We had talked about over the past couple of monthly analysis videos that this, as a monthly higher low, is starting to look constructive. And if the month of July can close for some kind of higher high, if this move can sustain itself in the upward direction, that would also be constructive, obviously, in the upward direction. Let's check in. Again, there's no indication of a pullback, but I would argue staying over this is going to be key for walking forward. You could also make the argument that this level is important as well, but I would really just take the last swing high here. Let's bring out the Fibonacci's, though, from here up to here. We're well above the 38.2. Obviously, all of this is going to constitute bull flag consolidation. We could also check in, because this is probably meaningful, from the all-time high to the pullback lows of this long-standing consolidation right up against the 61.8. And you know what we say here around the channel, if we can start closing bars over the 61.8, that dramatically increases the odds that you're likely to see some sort of 100% retracement. So watching that 212 zone quite closely, and you could argue that we're maybe splitting hairs here, trying to navigate the difference between like the bottom of the balance. Did we close above? Did we close, below? We're sort of like right at that inflection point. So really seeing price acceptance over 212, over 213 is going to be the next major step out of the weekly time frame if you're going to get outperformance in the upward direction. Let's take a quick look at the anchored VWAPs on the weekly time frame IWM. All of this clusters underneath us. That really hasn't changed much. We're probably going to start adjusting some of these in maybe next week's episode if this sees follow through in the coming week. And then we also want to check in on the volume profile and just make sure we're good to go from this point of view. The most constructive thing to say is that the low volume void is starting to be rotated through, and your target up overhead is going to be the midpoint of the balance based on volume, at least closer to 224. So is it possible that we see continuation breaking out of this compressed range? Absolutely. Remember the concept that markets move from range compression to phases of range expansion. If this is the beginning of expansion, it's still very early on in the possibilities of upside continuation. Let's drop this back down to a daily time frame chart, jumping on over to the IWM. Let's take a look at what we've got. So we were able to get out of the GFR, the godforsaken range, in this area back here via the CPI gap up and even the PPI gap up, even though PPI data came in slightly hotter than the expectation. Kind of interesting. But on the daily time frame, let's do what we do best. What do we see from the weekly expected move? The upper bound, 217.87, obviously upside continuation, new higher high. If we're contained by the lower bound, the number is 208.40, and that's sort of, it's a little bit further under, I would say, than my preference would be, this prior swing high we were just describing on the weekly time frame chart. So the best case scenario here out of the IWM, let's firstly acknowledge inverted hammer on the daily time frame chart, would be some sort of like gap fade and then trying to find, something that does this back in the upward direction or holding up over this prior structure, right? We've mapped this out for a reason. That's 209.75. If the IWM this week is over 209.75, I would look at this market and say, great, this is going to act as a big tailwind for the S&P 500. But wait, Matt, you just said that the NASDAQ could potentially break down. Isn't that going to act as push and pull? Absolutely is for your S&P 500. So more neutral in the S&P as long as this IWM sustains itself if the QQQ is pulling back. If the QQQ says, you know what, that's all the sellers really had, we're going to start making new highs, we're going to gobble up that inside inverted hammer, guess what? This is like firing on all cylinders in the upward direction for the S&P 500. The S&P is the place to be long. If you're looking for a short, the isolation in the QQQ is probably what you'd like, right? So anyways, keep it simple on the IWM daily, over 209.75, under 209.75, gap fill reversal above. Those levels are 212.85, closes down at 211.30. Your next major overhead resistance based on structure is over the top end of the weekly expected move at 219.75. Hourly time frame chart's going to look pretty wacky here. There's really not much to read into. I do like that on the Thursday gap up, it was a gap and go, right? So it's not like we put in a bulk of the range here and there was an afternoon spike that closed the market strong. It's a morning sort of, move to the upside. I would argue it's sort of short squeeze out of small caps and a lot of initiative trade getting into small caps, and then consolidation on the highs. Follow through on that Friday session. Now, again, it's not like we consolidated on the highs of Friday, but generally speaking, there was not even a test of that Thursday range. So is it possible that there's some kind of like flush point that's developed here, descending triangle, a little bit of gap close? Sure. Underneath 212.85, we just talked about closes to 211.30, would be looking for a reversal here, then possibly it's a pie in the sky, inverted head and shoulders. If it's deeper than that, I would start thinking about opportunities that look like this, inverted head and shoulders, a low that's underneath this consolidation low, and this 209.75, you just saw it from the daily and weekly time frame chart. So the fact that the hourly was battling for acceptance and was literally spot on to the level, it tells me that the IWM is trading based off of a technical basis right now, which is probably a good indication for us traders, right? If we could spot this higher low after sweeping underneath, that would strike me as a long setup as well. The bears, of course, want to look for price acceptance underneath 209.75 and really be swinging for this gap close down below. Before we go any further, let's take a look at the daily time frame chart and let's evaluate what took place on the previous CPI gap up. It was fade, 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 making new lows, right? New low underneath this in the sequence. This has stuck so far, but I'm not just going to throw my hands in the air and throw caution to the wind and say it's time to party because the IWM is gapping up. This could easily give some of this back. I would prefer it didn't, but it could give it back based on our previous experience with CPI. Look at the volume that transacted. We don't often analyze volume, but when things are this obvious, I think it's worth bringing up. What would the magnitude of volume tell us about the Thursday and Friday session? Once again, I fall back on that term I used just a moment ago. Initiative buyers are getting involved in the market. This is not just like Trader Sally and Trader Joe in the overnight session gapping this thing up. This is like pension fund, hedge fund, like stronger, large, you could call it, quote, smart money or big money, whoever is getting involved in small caps. And I think that's worth making note of. As we take a look over at the market internals for the Russell side of things, huge volume inflows on that Thursday session. Makes a lot of sense. Advanced decline line strong here, strong out of the cumulative build. Notice the Friday turnaround with the inverted hammer that printed on the daily. So that to me is somewhat interesting. One of the things we could also read into, we didn't do this over on the S&P or the NASDAQ, but I think it makes a little bit more sense out of the Russell. Let's go full screen, and I'm just using the futures because we have the overnight turned on already. On the PPI data, notice that there was a flash in the pan to the downside. Where did we find support? As I'm thinking about whether or not we have stronger sellers trying to sell this and short small caps at higher prices, the answer would seemingly be absolutely not. Look at the sort of response there. I don't know if you just saw that. Looks like maybe there's an internet issue, but we're going to try to move through some additional charts. If we have to switch platforms, we might. But we covered the internals, right? We're all set on this dashboard here. Let's jump on over to the market profile for the Russell side of things. Again, reinforcing that the buyers did step up and they continued to hold prices near those highs on the Thursday breakout. And as we look towards the Friday, value did not shift higher with the prices. Again, this candlestick chart sort of reflected this directly as well. Wouldn't be unreasonable for me. I wouldn't be shocked to see that gap try to close come the early stages of this upcoming week's worth of trade. So with the delayed data trying to reconnect, let's see if it's an internet issue or a platform issue and jump on over to our S&P sectors. It is a thinkorswim issue, not an internet issue. So let's jump on over to TradingView to finish off our S&P sector analysis, as well as all of the other charts we typically look at, as well as that additional chart I promised you today. We can still get that over here. First and foremost, let's paste this little screenshot into the platform. What do we see in terms of weekly performance of the S&P sectors? Leading the pack is real estate, up a whopping 4.39%, followed by utilities and the XLB for materials, up 2.65%. All three of these sectors are very lightweight in the S&P 500, and utilities are more so D for defensive. They're also all very interest rate sensitive, and we know that the 10-year interest rate fell off of a cliff when the CPI was announced. So not a shocker to see these names leading the pack. We know that the market had pulled back on Thursday as well. We did try to rebound on Friday, so weekly posture does make sense that a pullback wouldn't be unreasonable at this point in time. The laggard on the week is the XLC communications sector, down 1.7%. A lot of the damage done there is, of course, due to Meta as well as Netflix. You'll notice that XLP consumer staples is towards the bottom, as well as the XLK tech sector, the heaviest weight risk-on sector for the marketplace as a whole. Let's get this sort of off and hidden for now, and let's just check in on the charts. We're not going to have all of the key levels here, but we can at least evaluate what's going on with the trends and where sort of some major inflection points are. If the XLK can stay over, what would this area be? I'm just going to hover my cursor here in today's episode, 230, 250s. That would be bullish. This is nothing more than bullish consolidation. Call this a bull flag. Looking for follow through over time. The trend is certainly up, and we can afford a higher low. Ideally, this higher low is off of the prior high, but I would make the argument that on a weekly time frame chart, if the tech sector really needs time to cool off and settle down, any consolidation over 220, 250 is a-okay for this market. If we start to drop that and get into the sort of category of closing gaps and maybe downtrending on the daily time frame chart, it would certainly raise some questions, raise some eyebrows, and we would reconsider. As of right now, we're just simply not there yet. So bullish until proven otherwise, but on close watch. Here's the XLF. What do we see out of this chart? I don't know about you, but it's certainly looking more so like a longer run ascending triangle. And if we quickly flip on over to a monthly time frame, this is, wedging basically right into blue sky territories. Bank earnings are well underway. JP Morgan, Wells Fargo, and Citi all reported on Friday. We'll check in on those charts, and there's no big impact. Even though the sort of Wells Fargo's earnings did not go great, large gap down there, the actual sector itself is holding up just fine. So as of right now, the technical structure out of financials looks great, noting it's the second heaviest weighted sector, watching to see if we can get a breakout. The ideal pullback to hold, if there is a pullback, is just the midpoint of this range. We had talked about this as sort of the neckline of the inverted head and shoulders as well. 41.65, there's your inverted head and shoulders. As long as we're over that neckline, good to go. Chart looks great. Next up, XLV. A couple of higher time perspectives to bring in here as well. This is a long-standing area of balance, which is broken out. And on the daily chart, you got another micro balance here, almost like the XLF aiming for blue sky territories. If you can break out of this daily range, yes, the XLV is technically D for defensive, but it's the third heaviest weight sector by market cap in the S&P. Even if that tech sector takes some time to cool off, if you get that weekly consolidation we were just referencing, if this, healthcare sector can break out, if the financial sector can break out on positive earnings, it speaks directly to the rotation in the S&P side of the market, looking for your short in the NASDAQ side of the market. And if the NASDAQ does decide to just, hey, we're going to hold a higher low and continue the rally, everything's firing in all cylinders on, in the upward direction here. Let's move along to the XLY consumer discretionary. Huge move to the upside, obviously, on the Tesla rally. A little bit of give back with the 8.5% down day from Tesla, but nothing major. Rebounding, putting in some sideways consolidation. You're mainly going to want to watch these lows. If you get a breakdown underneath 188.50s, give or take, I think you could see a little bit of a pullback through the thin structure into the prior highs from back here. This level to get it for you is going to be at 185. So structurally, chart looks fine. Even if there's a breakdown, yes, it might be intra-week bearish pressure for the S&P, but looking for a daily higher low up against that retest. Once again, 185.50, did we call it? 185 flat. 185 flat. Next up, XLI. Industrials, sideways in a balance range, nothing to talk about here. Communications, a little bit of a pullback. It was, again, one of the only red names on the week, but is it really, is this a detrimental looking chart? Absolutely not. I think that, overall we're in an uptrend. You've got yourself a support trend line coming in probably closer to this pullback level. What is that? 85.20, 85.25, maybe 85.35. If you could capture that as an area of support in this general zone, I would still be constructive on the chart. We're pulling back from highs. This is the improper end of the auction, very equal highs. Yes, it's a double top. Yes, on Friday, you saw an inverted hammer upper wick reject the neckline. So let's not try to hide the fact that a pullback is totally reasonable here, but you're still in the context of a bullish market out of communications, not the end of the world. Next up, XLP, sideways in a balance range. Anything to talk about? Absolutely not. Over the highs, under the lows, until proven otherwise, neutral for the market. Next up, energy, trying to spot the double bottom. Whether or not this can break out over this neckline, that to me is sort of interest. If you take a look over at crude, if we go CL, I don't think we need the no slash on the trading view charts. What do we see over here? A little bit more neutral consolidation after a pretty substantial run in the upward direction. So energy, it wouldn't be a shocker. If crude holds up higher, I would sort of look for that possible break up and over this neckline right here. That level, just to give you an idea, is at 91, let's call it 92 flat. Over 92 flat. And then from there, and we'll get into this as we talk CPI, but energy inflation did not show up yet again for another month in a row. Actually, energy deflation to the tune of 2%. We'll get to that in just a moment, but speaking of energy, if it were to break out there, that would certainly have my attention for the follow-up read in inflation. So watching this closely, watching crude closely, it continues to be on radar for those reasons. Utilities, big upside move over the neckline of what we were calling the double top from back here. So walking forward, if you could hold up over the 50 SMA, I would even argue for this level right here, as long as this gap remains open and you don't fill it, a higher low over, 70 flat? Over 70 flat in utilities would probably be upward pressure, and I would start to just think about this in the back of your mind as possibly a risk-off indication if this continues to chug along or holds this, and the broad market, aka the SPY, holds up near its highs as well. So utilities, just monitoring the threat for a possible risk-off rotation. Real estate, obviously big upside with interest rates absolutely collapsing. We'll see if there's any sort of clearance of these major pivot highs until proven otherwise. Higher time frame in here. Yes, the swing high is important, and if anything, it's just slight upward pressure for the market. XLB materials, similar concept to utilities, I would argue, where the threat was underneath the neckline of the double top, 1 and 2. Now you're clearly back above, so no issues out of that. Upward pressure, if anything. New swing high over this would be more informative for the broad market. SMH Semiconductors probably could have been tagged along with the XLK, but it's the same exact comment. You did make a higher high. The pullback level is not as well defined, and I would really look for this. If you guys know the NVDA chart, you also know that NVIDIA has a double bottom, 130-ish area, right? So if you can hold up over this neckline, if you will, that would be something like 264.50, and we'll probably post a mega thread of analysis over on X with the Thinkorswim charts tomorrow, Sunday, once the platform is back up and running, if you're looking for the more accurate levels. But generally speaking, somewhere in here around this 264, if you could hold up for a higher low, the trend remains intact and the market still remains optimally bullish here for your S&P 500. I'm not seeing the evidence, and this has been the argument from Thursday's video as well, for any larger downside indication. We don't have the, do we have? Yes, we do. We got some specialized ratios and some not so specialized ratios. This blue is going to drive me mad if I don't turn off those moving averages. And there we go. It's still going to drive me insane. So let's see if we can quickly flip this together and just make it a white line. That's a little bit better. All right, so what do we have? This is XLK versus the SPY. You got your higher high with the pullback on Friday, so or Thursday/Friday, not overly concerned. It's still in an uptrend. It's carrying the weight for a risk-on indication. If you take a look at the XLF over the SPY, leaves a bit to be desired. This has been one of those things that we were looking for improvement out of for quite some time. We wanted to see double bottoms back here. You're just not getting any of that big response to the upside. If bank earnings earlier on in this upcoming week can continue to fuel the fire in the XLF to the upside as the SPY possibly pulls back, that would be a decent indication for a move to the upside out of this ratio. That would be a risk-on rotation. Here's the XLY over the SPY. This is making subtle improvements in the upward direction. The other thing I'm curious to see, maybe this is going to help us understand what charts we're on. There we go. So you can see in the background XLY, SPY, so I don't have to say it every time. Here's healthcare relative to the SPY, right? This is still falling off of a cliff. So if we're thinking about a risk-off rotation, not there yet. If the breakout happens as the market's pulling back, this might change a little bit, but remember, third heaviest weight sector by market cap. If you're ever going to see a risk-off sector move, this is the one that you want to see. The ones we don't want to see are things like utilities. This is utilities versus the S&P, sharp recovery in the upward direction after CPI. No surprises there. Is it really threatening a new swing high? Is it out of anything more than what I would argue a long-run downtrend? Probably not. XLP is consumer staples, and this is still in a downtrend, so we are not seeing a risk-off indication over here. As we get into some specialized ratios, we have XLK, XLU, so tech versus utilities. Didn't quite get the follow-through I was looking for over these highs. And again, if the market's dealing with a pullback, this actually is supportive of the pullback idea in the S&P 500. Let utilities sort of run the show for a little bit as tech cools off. You might get a rotation in the S&P, but because we didn't make that new swing high as the market made a swing high, sort of checks out as being, all right, let's dial back expectations a little bit here at this new push. Next up is tech versus, government-backed short-term bonds here. Makes sense that this is obviously still bullish, especially as rates come down. It would just sort of seem to me that this would continue that sort of direction. What's going on with the discretionary versus consumer staples? I like the new highs. Remember that this was a long-standing sort of pivot zone. The fact that we're trading above this 2.4 makes me feel, again, like the risk-on rotation is still very much so alive and well. I would have preferred to show you these charts over in Thinkorswim, but the chart I promised you in the intro is this one right here. This is the QQQ versus the IWM over the IWM divided by the IWM. This is a ratio chart, of course. And what I wanted to talk about is if the tech sector is going to see rotation out of tech into small caps, typically that's not the best indication for the S&P 500. Let's jump on over here to the SPX as an added with the same percent scale. And, what are we trying to do here? Again, this is why I would have preferred to show it to you on the native charts. But what we're trying to illustrate is that this isn't an overall uptrend. When this isn't a downtrend, this is your downtrend over here. Here's your downtrend in the S&Ps. If I break that market, there we go. You guys can tell what my native platform is, right? As this white line drifts into a stronger downtrend, that's when things become detrimental. When there's clearly a preference for small caps over the NASDAQ growth side of the market, that's when we become concerned about longer run bear markets in the S&P 500. So as we're seeing this rotation, and then there's an argument, right? It's like, oh, wow, look at all this money coming out of tech. It's not going to bode well. It looks like a recession. As long as this white line here is in an uptrend, and that's clearly marked, we're pulling back from the highest high. It's very possible that you get a higher low over this breakout point, right? Anything that does that, really constructive here. And it's not so much about, oh, what's that exact level, Matt? Just monitor the ratio chart. If the ratio chart of the QQQ relative to the IWM is in an uptrend, I wouldn't really be overly concerned about recession money flowing out of tech and some sort of you wouldn't even call it a flight to safety in small caps. It's just a sporadic trade as interest rates reset by possibly being cut. We know the Fed's telegraphing that right now, which would be bullish for the operating environment of smaller companies, right? So long story short, this does strike me as a bullish look, certainly counter trend. And yes, you could see some weakness in the tech sector until we come into this area. But, is it a long-standing downtrend? Is there a threat of the S&P really moving more aggressively to the downside? After a breakout like this, I would tend to think not. Let's move on over into a couple of other indications here. I think we might have to get rid of this via the trash can. There we go. And we can go back to candles here. What do we have out of the dollar? Dollar rolling over aggressively makes sense considering the interest rate forecasts here with the CPI on Thursday. Gold, big break back to the upside, making sense with the dollar move lower as well. Silver, following suit, also moving higher. What do we see out of the 2-year? So this would be the closest to the inverted ZT that we're looking at over on Thinkorswim. Moving lower. Again, no surprises here. The Fed's telegraphing, hey, we're seeing improvements in the data. Probably makes sense to cut rates here sooner rather than later. The 10-year aggressively down underneath that 4.33. This is the zone we've been tracking for the past, it feels like forever. And the 30-year, while we're at it, we may as well take a look. We are underneath the inflection point here as well, which is closer to 4.45 on the 30-year yield. Let's go on over to the tracker tool now, and it's kind of convenient being in an internet browser, just doing this all in one. So anyways, 93.8% odds of a pause continuing in the month of July. That's just in about another 15 days here or so. And then the first cut is really being priced in aggressively now after the CPI and PPI. As soon as, September, you can see September's odds are about 90% for a cut, and that is dramatically improved prior to CPI, right? This is a screenshot we took ahead of the CPI release on Thursday, where we only had air quotes there, about 68.1% odds. So the market's feeling pretty confident right now that the Fed has kept things high enough for long enough and real rates are basically high enough, you could, click up something like the real yield of the 10-year. It's about to break out over 2%. If the Fed does not action in July, then the CPI print as that gets priced into the real yield will mean that real 10-year rates are over 2%. We haven't seen that in a very, very long time. So check that out on maybe your own time there, and we'll jump into a couple of the data points that came out. This is the coming week's worth of trade. We want to go to the previous week's worth of trade so we can dive into exactly what the data looked like. Core inflation beat on all counts. If you take a look at this column right here, it beat the consensus, and obviously it's underneath the priors. This is impressive. It's meaningful data. Jerome Powell has continued to parrot to us. We're looking for improvement in the data. We have not seen meaningful enough improvement in the data. I don't know what he's waiting for now, but this certainly looks meaningful enough to me. And then if you look at the PPI, a little bit hotter than the consensus here. You'll notice especially the core coming in at a 0.4 versus a 0.2 as the expectation there. Not the end of the world. It's not going to rock the world of the market here. Obviously, we saw what happened on Friday anyways, but something to consider for the next read. So as we're diving into the CPIs and we're diving into what the Fed might be looking at here, energy deflation has continued to persist month over month, even though crude is higher. Is this going to stop being a deflationary force in the next read, considering what we just saw with the double bottom in the XLE potentially brewing, and we know that crude prices themselves are also in the upward direction? If you think about the sort of pass-through costs of transportation, shipping, just the cost to get goods to people's hands, it wouldn't be a shocker to see energy impact all items as a whole. Food at home, anything outside of that, commodities, what am I saying? Just all of these things in this area, right? Apparel, goods inflation coming back. It's a possibility. It's not something that's going to shatter the market. What's most impressive here is the lag impacts finally catching up with shelter. Notice that we had not seen any reasonable month-over-month readings for a very long time at this point, like way before the sickness cycle as well. This is the first time we're seeing a 0.2 on the month-over-month. That's a really strong indication that the services lags are starting to catch up. And if Jerome Powell doesn't react, basically the lag impacts will likely do more damage than they do good. The next major indications to start thinking about, of course, will be the next cycle of jobs numbers. And if we take a look at what happened last week, I suppose we could just go back on this calendar as well. We want to look at the unemployment claims. This is actually a really strong read. I like what's going on here. Unemployment claims typically happen in a parabolic fashion. Notice over here, whoa, right? Things get kind of hockey stickish. The fact that this did not go hockey stick and get off the charts, the fact that the expectation was up here and the labor market beat the expectations by coming in underneath, to me is a good sort of like, all right, inflation's coming down. Yes, there was a small increase in job loss. We know that the unemployment rate ticked higher slightly. Nobody should have been shocked by that, but we're not sustaining this advance in the upward direction. Generally, the labor market tends to accelerate very rapidly when things are deteriorating. So this previous week's read in the initial jobless claims does strike me as a little bit of a lifesaver when we're trying to evaluate what's happening here from a fundamental perspective. Jerome Powell certainly does not want to break the back of the labor market. Otherwise, we sort of fall into this spiral where you get all of these mass layoffs, less consumer spend, less corporate earnings. Now we're in a recession, right? The biggest news this upcoming week will be the Empire State Manufacturing Index. It looks like Powell will be speaking on Monday as well. They snuck that one in at 12 o'clock. As we move further on into the week, retail sales on Tuesday at 8:30. And then as we get deeper on, it's also going to be all about the unemployment claims, noting the beat that we just experienced last week. Does that persist, or was that a fluke? Is the labor market actually going to deteriorate more rapidly with, all of a sudden these big reads that are missing the expectations, and not in a good way, obviously in a bad way? Earnings are also top of mind. We had JP Morgan, Wells Fargo Citi, they already reported. Goldman Sachs, BlackRock, Bank of America will be your next big couple of banks. Morgan Stanley, Charles Schwab can get lumped in there as well. And then this is going to be interesting from a semiconductors perspective. ASML and TSM always report earlier on in the cycle, and obviously NVIDIA is generally the laggard way out in time. We don't have to worry about it yet, but this will be interesting to see how things are actually happening with the manufacturers and not just the designers of these chips. Is the demand there? Are they still profitable? Like, what's going on with this increased demand? Is it true? So watching out for all of that stuff, let's jump back on over to quote the platform, which is not the native platform, and see what's going on with risk appetite. We could take a look at some of these charts. This ratio, TLT S&P, still in the gutter, so that's of course risk on. This is our sort of bonds in shortest duration, still in a downtrend there, all set. Medium duration, downtrend speaks to being okay, and longer duration looks good as well. So there is preference for equities right now. Credit spreads are not expanding at a rapid rate. If anything, they fell late in the week, and that, of course, is bullish. The lack of credit event, or a credit breakdown, if you will, is bullish for equities, or at least in terms of the risk appetite in equities. Same thing here in the shorter duration credit spread, SHY, HYG also moving to the downside. HYG in isolation, if we actually overlay, this is going to be massively divergent actually from the SPX, but let's just do it anyways. And what we wanted to look at, can we get an hourly chart here? Yes, we can. That's so wonky. I guess we're not going to be able to look at it, and that just goes to show you my deficiencies in TradingView. I might have to work on it, but obviously, what do we know happened into the end of the week with the SPY that we just did a full deep dive on, right? It broke down, it pulled back, it closed inside the range. What did the HYG do? It continued to break out here. This speaks to risk appetite remaining strong, even though the initial stages of a pullback look like they're there in the S&P and the NASDAQ. What about Bitcoin? Let's go back to a candle chart here so we can kind of see it. And let's go away from the hourly to the daily. You can see that it's getting a bit of a bear flag indication underneath the bottom end of this overhead range. The levels there actually weren't too far off, considering we have not updated that in a while. Market breadth, new highs versus lows. We need a line chart for that. Huge spike in the upward direction. Again, you want to speak about breadth. You want to speak about your market internals, the quad that we were looking at prior. This just reinforces that same idea. Stocks trading over the 200 SMA, also seeing a meaningful uptick here this week. That makes sense to me. SPX A50R, also a big move in the upward direction. Breadth has improved. RSP doing the same thing, breaking up towards these highs. We can go back to candlestick charts, and the key level we were watching was this 163. I think we were watching like 163.63. That seems to ring a bell in my mind as the key support, and we've accelerated massively off of that. We have not made a new pivot high, so that would be your next watch here out of the RSP. If breadth is going to continue to improve, then what you want to see happen is any pullbacks here basically digest and stay over the top of this range and make a new swing high to play catch up to your weighted ETF itself. I don't believe this is the QQQ. Oh, it is. It looks like the E is maybe being cut off there. This is the equal weight NASDAQ. It did make a new higher high on that Friday session, which is totally reinforcing the market internals that we saw over there as well. What about volatility? The VIX, as I said in the intro, on a relative basis, volatility is still not here. Might have looked like a volatile, Wednesday, Thursday, Friday, but really not at all. The VVIX also not really elevated. It did not make a new swing high up and over this previous shelf. If it did, we would sort of ring the alarm and say, hey, buckle up, a pullback seems to be imminent. Not the case as of right now. And what do we have out of the futures? These are the VIX futures. The back month versus first month, still over the zero line, means that we are in a contango, meaning money managers are happy to allocate capital currently. I can't promise you that any of these companies have accurate levels on them, so what we'll do is exactly what we did over on the sectors. Let's go ahead and see what's going on from a high level perspective, and then I'll send some charts out over on X again. Some of these things are out of our control here with Thinkorswim being down, but as long as we're over this on Apple, no real concerns. This is just a big break to new highs, pull back higher low, rock and roll. On Friday, it's technically an inside bar towards the upper 50% of Thursday's breakdown. If we go to an hourly time frame chart, I could easily see a world in which this just consolidates here and a break through these highs brings in new all-time highs. So Apple's not a big concern to me. The bigger concern would be underneath, what is this, 225? Under 225 gives you that deeper pullback opportunity into these prior highs around 220 that we were just referencing on the daily. Here's Microsoft. Again, those levels have been obsolete. Goes to show you where I do all of my charting. We've got ourselves a possible lower high. What I do find kind of interesting about this is the breakdown and consolidation underneath. We had some pretty nuanced levels over here. There was no Stevie Wonder trade on the Friday session. So the more time we spend underneath, I believe, what was this level? Yeah, 456 flat. That was definitely the number. That one's ringing a bell. Under 456 is generally just like bear flag consolidation. I would say that the next major inflection point to be thinking about here is somewhere along the lines of 445.50. 445.50 coming into this prior pivot low down here. So bear flag, looking for that to sort of extend. Measured move makes sense as well. When that happens, if that happens, on the daily time frame chart, right, that would bring us back down to somewhere in here. I'd be thinking about what's the opportunity for a daily high or low. Remember, we're pulling back from the highest high. I don't want you to lose sight of that. Next up is Google. what's going on with Google. Let's get rid of some of those drawings so we can actually see what's happening here. As long as we're over the breakout point on the weekly chart, we're good. Daily chart, I would argue we're good as well. We are starting to drift underneath this shelf. What's that level at 185.75? So if we can get back above that, it's back to being bulls on parade. I would expect a repair basically of this all-time high. It's the improper end of the auction, 2 equal of highs. Earnings season isn't quite here yet, so we've got about a week and a half to go before these names start to get backburnered for earnings adjustments basically, and volatility out of implied volatility. Volatility out of implied volatility. This platform's screwing with my head too. Almost a rinse and repeat of Friday's pre-market prep, right? Anyways, this bear flag is in play, and again, we sort of talked about where we're all set on the daily. If you're going to be long, it's got to be a clearance of the top end of the range here at 186.75. If you can clear 186.75, I would be thinking about this as a target at 189, and then being mindful of the threat for a lower high, right? It's very possible that Google changes trend here if the broad market or the technology sector cohort is going to see a bit of a reversal. So watching that as a threat out of Google. Let's move along to Amazon. Amazon, these drawings are driving me mad. Should have done my homework before starting up the recording. Anyways, flat top highs are not repaired. Over 200 gets interesting. Currently dealing with a bear flag underneath the bottom end of a 4-day balance range up here. Bearish until proven otherwise in the short term. In the long term, it's bullish as long as we're over like this 190 area, right? 190 on the daily time frame chart. Huge breakout of the ascending triangle that hasn't gone anywhere. This is a break, possible retest looking for the higher low. There's your Brigade bolt. All right, so 190, still a top watch out of Amazon. NVDA, here's the double bottom we were referencing over on the SMH Semiconductors. Great pullback into it on Thursday. Friday tried to rebound off of it. Not thrilled with the Friday close there. On the hourly time frame chart, you can sort of see how we looked over this 130. We even tried to hold it as support sort of during this consolidation, but the close is just so clearly back down underneath that level. If stronger buyers were going to step up, or if shorts late to the party were going to squeeze out, this should have accelerated more rapidly towards the Thursday high of day. It just simply did not take place. So still watching very closely 130 as a level out of NVIDIA. And then to the downside, right, your neckline of the double bottom is more closely aligned to the lows of this overall pattern. 127.50, I believe, was the level. Yeah, 127.50. If we're below that, I would just be aiming basically down here at these equal lows closer to 118, 119, give or take on the downside. Next up is AMD. What's going on with AMD? Taking a closer look. Double top, possibly. Remember, we had that very nuanced level here around 183.15. That one I remember clear as day because I liked the close back above on Wednesday, as well as here on the Friday morning recapture rather. So the fact that it did not hold over it on Friday's close leads me to believe that this is just a very classic double top underneath the neckline here, and you could start to see some further downside out of AMD causing a pullback. But so your level to watch, 179. Underneath 179, if you want to use the exact lows of the wick, I typically don't cherry pick wicks, but those levels are at 177.50. If we go to the daily time frame chart, I don't want you to lose sight of this, right? Can we just get a simple retest of 172.50? Something that does this. There's your Brigade bolt, trying to spot higher low opportunities over the top end of the prior balance back here. Metaverse is up next. What do we see out of the verse? This is ugly, right? And this is a lot of the issue that happened with the XLC communication sector. If you look at these flat lows after a 100% retracement, inverted hammer closing a majority of the gap and then not really closing up near those highs, closing back weak towards the lows, I would be more partial to downside underneath this flat bottom. That's going to be closer to 493. Underneath 493, this gap is still unfilled out of Meta. That's under 483.70, closes back down to 479.30s. So watching out for maybe something that does this and then tries to support over the top end of the range if the tech sector is going to hold up as a whole. If it doesn't and it just stays underneath this breakdown point, again, 493, if you're just getting acceptance under this, then this, of course, is all overhead supply, kind of ugly and probably drifting into a longer-term consolidation, considering that overall, haven't really made much progress out of Meta. I'm impressed with the recovery off of the previous earnings cycle, but other than that, this consolidation, this over here, there's been great trading opportunities. Don't get me wrong. I'm not trying to take away from the trading opportunities out of Meta, but generally, the sentiment around the stock is that we really haven't done anything over the past bit. Really all of, I shouldn't say all of 2024 because we started down here, but the Q1 earnings cycle, right? Or Q4, I should say. Let's move into Tesla, see what's going on with Mr. Musk and his rocket ship. If we're taking a look, the pullback, very, very short-lived. I like that there was sort of a gap fill reversal here on the Friday session, closing back inside of Friday's range. Let's bring this one down to the hourly chart so we can get a little bit more granular. As long as, so this is my argument, as long as Tesla is over 241, let's call it 242. 242 right here. As long as we're over that, I think that this is totally shorts got ahead of themselves. People bought the dip, and it's trying to navigate back up towards these highs at 265. If we're underneath that 242, that's where I would start to change my tone a little bit and say, okay, maybe we come back down into the next gap close as well for a possible daily or weekly lower high. The weekly pattern that's in force is this as a head and shoulder, inverted head and shoulders, and your neckline is like way down below. I'm not arguing for a test of that neckline. I'm just sort of saying, you could bring out fibs as well on this. If you do something that looks like that, I mean, you held up and you closed over the 38.2, your 61.8 line in the sand kind of keeps you over this prior gap. I would give it some leeway and say a gap fill reversal that promptly recovers the 61.8 would be just as bullish as not testing the gap in the first place. Let's move along to Netflix and see what's going on over in this name. This one breaking down aggressively from this range, another issue with the communications sector, and failing into this prior range as well. So I would be bearish on Netflix here for a daily trend reversal. You could start to envision how maybe this is like a Man Ray pattern that's developing. Any lower highs that are set underneath the bottom of the balance, let's go down to the hourly to be a little bit more precise with this. That's going to be here at 660. Let's call it the unlucky number, 666, straight across the bottom. Let's say there's a stronger counter trend move. Any sustained lower highs build out your daily head and shoulders, looking for downside. And even here, notice if I do something that looks like this is already a pretty bearish takeaway with a lower high being set underneath this breakout point, Netflix unable to sort of recapture and try to get some thin structure retracement, not only through this, but way back over here as well, just totally rejecting that area. So not thrilled with the chart out of Netflix, looks a little bit more bearish than bullish, trying to trade some downside. Your next downside target would be the bottom end of this range, closer to 630. Next up is JP Morgan. Let's go ahead and clear this one up. And we'll take a look at the daily time frame chart to begin with. And so I like the daily trend reversal. We talked about this one, right? Inverted head and shoulders, break the neckline, we're off to the races. I like the consolidation. The issue is just that we started to reject that in the Friday high. So the next step here is that we need to hold up, over the breakout point, which is 200. As long as JP Morgan can hold a daily higher low, so lows, higher lows, higher lows, trying to align with trading this in the upward direction. So JP Morgan 200 key level. If you can recapture the bottom end of the range, let's go back to the hourly just so we can see this. If you could recapture and more aggressively not suggest the upper wick somewhere around 204.75 right here, we kind of closed right on it. It's very difficult to say that that's acceptance yet, but if we can get back above, what's your breakout trade? It's over these flat tops into the all-time highs, and that level is 208, over 208, and you're back off to the races in JP Morgan. Let me go ahead and pull up on another screen here what the three trade ideas were. Again, this platform's throwing me off a little bit. We got CrowdStrike, CRWD, and let's go to a daily time frame chart, and we can all see kind of what we're looking at here. Notice the multiple inside bars on the Thursday and Friday session. This was already weak earlier on in the week, not to overuse the term, and we've got this glaring gap underneath us. I'm looking for my toolbar. There it is. If we start to break down more aggressively underneath this 367, I mean, I think it's game on. Probably should have been doing this the entire time we were marking up charts. But anyways, down here towards 350 on the gap close, definitely gets interesting. So multiple inside bars setting up bearish pressure up against these equal lows. Give me the flush, and we'll look for that rotation to the downside. Next up is ORCL, and we'll see what's going on with this. It's the opposite. It's a bullish break after a ascending triangle has built out here over 145.50, and you're dealing with blue sky territory. So as long as this sort of earnings gap up can stick, I like the consolidation, I like the consecutive higher lows, I like the move into the equal highs, clearing 145.50, off to the races on that name. And last but not least is ON, which is ON Semiconductors, and I like the relative strength. We saw NVIDIA pull back, we saw AMD break out. If this wants to play catch up and money is going to continue to rotate out of NVIDIA, it's very possible that there's some sort of long that develops up and over this like 77 level. If we look left, there's pretty thin structure until we start retesting some of these highs. When I say thin structure, I'm referring to that little red breakdown in here. It's not like we have this little pivot and we did the dance in here and then there's this and then there's this. None of that. It's a pretty straight shot, and this certainly captures my attention in the upward direction. Friday upper wick, we've got to acknowledge, yes, but a Brigade bolt up here leaves some opportunity. Again, 77 up into about 82.50. So apologies for the somewhat mashed up second half of today's weekend update. It's sort of what we do. We're working on the run here. We're making it work with TradingView. So let me know what you thought. Let me know what you thought about the not the possibility, but rather the interesting chart we brought up here, which was back in the ratio section, the QQQ IWM. Do you agree with the take that as long as this is in an uptrend, it's not really recessionary? Do you agree with the take that when this flips into a stronger downtrend, we sort of become concerned? That's my take. We know obviously that there was some pain over here as well. So this to me is like top of mind. As long as this is in an uptrend, as long as they're possibly suggesting a higher low here, as long as in the grand scheme of things, as time plays out, the NASDAQ is more attractive than small caps, I would tend to think that the market continues to move in the upward direction. So that's going to wrap it up. Again, thank you for sticking through my not so well-versed skills over in TradingView. Hopefully you enjoyed the show. Anyhow, wish you all a green trading week, and we will, of course, see you in the next one.